Welcome to QAV. This is episode 6112. We're recording this on the 21st of March, 2023. This is our last recording before Tony disappears for a month and a bit. So if you don't have any questions in by today, don't bother. For a couple of weeks.
No, that's not true. We'll try and get some recordings in while I'm overseas.
We will try.
We
just had a great chat with Tim Lincoln.
Mm-hmm.
Finally, we managed to get Tim on. That'll probably come out as next week's show, I think. Well, we'll both be traveling. You'll be going overseas. I'll be coming back from Sydney. So people will enjoy that. He was lovely, really lovely to chat finally to Tim. Seems like a nice bloke.
Yep, I agree. It was great.
Well, I want to start off today's show by wishing a big QAV congratulations to Rupert Murdoch on his upcoming nuptials. He's not divorced from Jerry Lee Lewis yet, but he's getting married again after that divorce goes through to his fifth wife, who I'm sure is a lovely lady who's only in it for love and devotion and all sorts of good moral values.
It's possible that she has a thing for like men who are 30 years older than her, but yeah, it's
92-year-old immortals.
Billionaires.
Yeah, 92-year-old immortal billionaires. He said, I read a quote from him in the Fin today saying, this will be his last one, at least it better be. Something. 92. Wow. Well, listen, we've got portfolio updates to get into. Been a lot of selling from me in the last week, not a lot to buy. We'll get into commodity updates. But before we get into all that, TK, I've been working on a thing over the last couple of days I haven't shared with you yet. Kind of the maxims of QAV. Not, the fudge and the Josephine and those sorts of things we call the maxims. But going through... I've had a few of our club members call me and go, what are we going to do? The market this and the market that. And I keep saying this sort of little bon mots of wisdom that I've picked up from you over the years. And I'm trying to basically get the essence of the philosophy of QAV down to a handful of bullet points. So let me run through these with you and see what you think. Number one, the market always goes up over the long term. Based on history, if history is true, if history repeats itself anyway, for as long as there have been markets, they've always gone up over the long term. We expect that to be true, barring complete collapses of the global economy.
Yeah. Sorry. You want me to comment now or is at the end?
No, just do it as you go. Yeah, sure.
Yeah, well, that's called positive expectancy. So you're investing in an area that you think or generally returns a positive return. It has to be over the long term, I guess, but it's that's the reverse of going to a casino, which has negative expectancy. If you can play roulette, you can see it right there on the table in front of you. There's one less slot that you can win money on than you need to break even. So it's negative expectancy. So that's really, you're right. That's the essence of investing. You cannot invest where there's negative expectancy. You've got to invest where there's positive expectancy.
Right. So, number one, the market always goes up over the long term. Number two, the market goes in cycles, positive to negative, and then back to positive, crisis to boom, and back again.
That's what's it called? Is it Fibonacci? No, it's Mandelbrot. Markets are Mandelbrot. You can look at it between the hours of 10 and 11, and it will do the same thing. You can look at it between the hours of 10 and 4, it will do the same thing. You can look at the hours. Over the month of March, it'll do the same thing. Over the year, over 100 years, it goes up and down in cycles, but directionally it goes up. And it has to. Going back to point one, if the stock market isn't going up, the economy's going backwards, governments are in disarray. We have many more problems to worry about than the stock market if it's not going up, and that's why everyone pulls all the stops out. If they're a regulator or a government, to ensure the stock market goes up.
Number three, in between those cycles, it's always erratic, good weeks and bad weeks.
Mm-hmm.
Number four, there's no
testing.
Testing?
And testing. It's always testing you.
Oh, testing you. Yeah, right.
Yeah.
Number 4, there's no crystal ball to tell you when the cycle changes from positive to negative.
The market never rings the bell when it's at the top or the bottom.
Number 5, stay fully invested even during the negative cycles, because you never know when it has turned around until you have hindsight.
Yeah, I mean, there's times we'll go to cash, or at least partly to cash, but yeah, generally stay invested. As we were talking about with Tim Lincoln, the market doesn't ring a bell at the bottom, but you can sense capitulation when people start selling out, just like you're getting with questions now. What are we going to do? You know, that this is exactly the time when people change style, change their investment philosophy, or just sell out. And when that happens, it's almost like the decks are cleared and the market takes off again.
I've had a couple of people, not members, I think, but people that are light members or whatever, people saying, oh, I'm just going to go to ETFs. I'm like, that's fine. Just go to ETFs if you can't stomach it. Like, that's great. I mean, you know, this kind of investing isn't for everybody. Yeah, you got to have the stomach to just, you know, wait it out.
Yeah, and going to ETFs is better than going to cash or putting it somewhere else into, you know, another investment class. Yeah, definitely.
6, only buy stocks when you can buy them at a significant discount to their intrinsic value.
Why overpay? There's 2,000 stocks on the stock market. Why would you overpay for one?
7, over the long term, the stock price of companies that consistently perform well, i.e. generate lots of free cash, should do better than the stock price of companies that don't perform well.
Yeah, well, you can see that in your local coffee shop, can't you? 2 coffee shops, one next to each other. The one that's brightly lit, clean, you know, happy smiling staff is going to do better than the one that's hasn't had a sweep. The windows are boarded up, and the guy's smoking behind the counter as he's talking to, you know, his SP bookie while he's trying to make you coffee. It's just obvious that one does better than the other.
Like I just said to Tim about Stock Doctor, which I think they do a really good job of, have a good product and give great customer service. And I think they do both of those. And I think, you know, any business that does both of those tends to outperform businesses that don't do those over the long term. And 8, this is where I finished right now. Think long term, but preserve capital by setting stop losses, then reinvesting those funds as soon as you can.
Yeah, correct. Good.
Anything I've missed out?
Well, as I said to Tim in that last interview, I think you have to be aware that when you start down this path of investing for yourself, you're doing it for the rest of your life. You know, don't think this is a train that's going to stop at a station soon. You can get off and do something else. Well, you can, but you know, to make it work, you've got to stick to it for the rest of your life. Yeah.
I just think I'm thinking about putting these up on the website or something, because I think just trying to encapsulate the thinking that you've imparted to me about investing over the last 4 years, the philosophy, I guess, of how you invest, and just trying to capture that, because it, you know, as Tim said, it has been a difficult 2.5 years for investors. And it may continue to be difficult for some time, but I just keep reminding myself it always goes up over the long term. So we just keep doing what we're doing, and I don't really care if the portfolio goes up a little bit, down a little bit, up again, down. I have to sell. I don't care. As I said to you off air before, I'm kind of bored by all the doom and gloom in the news in the marketplace right now over banks collapsing and being bailed out and this and that. I'm like, you know what? I really don't care. Like, the regulators will do what the regulators do. Governments will do what the governments do. The market will go up or it'll go down. But eventually, it'll go up, and, you know, our portfolios will do well when the market stabilizes and goes up when the conditions are right. In the meantime, we're just minimizing the damage by letting stuff go if it drops too far, and, you know, playing a good, safe game of chess, you know.
And taking the emotion out of it. That's the important thing. And, you know, the last couple of weeks have been really tough for me too. I've had this kind of death spiral of Rule 1 sells and 3-point trend sells and commodity sells. And then I find myself in gold stocks, right?
Gold. It's all gold.
Yeah. And then I'm sure, you know, in a year's time or however long it's going to be, the banks are going to be super cheap and we're going to be in the bank stocks. It's like, I don't have to predict it, think about it. All I have to do is do it.
I was laughing about playing a safe game of chess because I was having breakfast with the boys on Sunday morning, and Taylor and Hunter were having a game, and Taylor is generally the best player out of the three of us by a long shot, but he struggles with playing his twin brother for some reason. There's this like psychological issue. Anyway, halfway through the game, Hunter was crushing him. Like, he played this sequence of moves that was tactically brilliant and absolutely had Taylor on the ropes. And it was really, really impressive stuff. And I said to Hunter, whatever you do, don't get cocky right now, because if there's some way, he's like the doctor. There's one person you never want to put in a corner. It's Taylor with a game of chess. And Hunter was like, no, absolutely not. No, it's what he called. He said, park the bus. He said, when we played soccer,
yeah,
we had this thing. If you get a goal up, you just park the bus. In defensive positions, you don't let anything through. Don't take any risks. And I said, right, yeah, it's good. And then Taylor crushed him at the end of the game. Taylor beat him and absolutely came back from having, a serious deficit and crushed him. It was insane. They both played so well in this game. It was super impressive. But yeah, anyway, so playing a defensive game, that's how I think of QAV right now. We're just playing defensively. The markets are all over the place. I'm just okay. Well, we sell stuff when it breaches the stop loss and buy something else, and just keep rotating the dice and just waiting for things to turn around. And they will. Don't know when, but they will. And when they turn around, we'll do well. And that's just how it goes.
Yeah, I mean, I know a lot of people are drawing parallels between now and the GFC, and I don't think that's valid because I think it's completely different. There are some, things to compare, I guess, but to contrast as well, banking being particularly one of them. But what does feel like the GFC is just how the portfolio is going down. And, we're having to pay attention to it a lot more than what we'd like or what we'd normally do. But, I'm glad I went through the GFC because I knew that that gave me the experience to know that portfolios can go down a lot, but eventually they'll come back. And then when they do come back, they come back like a freight train. And if you're not there when they come back, you sort of go back to sort of muddling through. You've missed out on the big game. So it's important to be there.
Well, our portfolio actually is doing quite well. The dummy portfolio I'm talking about. So I was doing my weekly report this morning, and from inception, we're now up 16.81% per annum versus the STW up 6.3% per annum. So we're still doing 2.5 times better than the STW since inception. And for new listeners, that's since the 2nd of September 2019. For the financial year, we've been underperforming, but we're underperforming by a lot less right now than we have been. The STW was up 10.95% for the financial year. We're now up 7.38%. So a couple of months ago, it was doing twice as well as we were for the financial year. Now we've cut into that quite a lot. And if I look at like the last 7 days is actually kind of interesting. There's been a lot of red, but then you've got LAU is up 15.5% in the last 7 days. RSG up 7.5% in the last 7 days. A lot of the other stocks have just been sort of neutral. But when I look at this quarter, so since the most recent quarter that we're still in, right, from the 1st of January through to the end of March, our portfolio is up 1.81% versus the STW, which is up 0.31%. So
yeah, and that's sorry, go on.
No, I was just going to say, it's sort of been turning around our performance vis-a-vis the STW this quarter. Like it wasn't that way a month ago. A month ago, it was well ahead of us for the quarter, but just in the last few weeks, since the SVB collapse and all that kind of stuff has been going on, we've actually recovered quite a lot.
Yeah, and it's kind of, in some ways, it's kind of surprising to hear the STW is up 10% odd for this financial year, given everything that's happened this financial year. So, the banks have had a good run, I guess, with rising interest rates, which has supported the STW. But yeah, I fully expected that not to last.
Yeah. So it's interesting how things turn around. Anyway, that's my portfolio updates. But yeah, as I said earlier, I've been a lot of selling, very little to buy. I think I bought some more OML today for the dummy portfolio.
Oh, shit, I'm
But
going to talk about that today. That's the pulled pork.
I know, I saw that. I was like, oh God. But anyway, yeah,
Yeah.
it's been very slim pickings out there. Nearly everything's either having a down day or there's a few things that are good in the buy list, but I already own, two parcels of everything because they've been the only
Yeah,
things
right.
I've been able to buy for the last few weeks. So yeah. Commodity updates this week. There was a few changes. Let me just bring up the buy list to refresh my memory. Um, com status. Thermal coal officially became a sell in the last week, which caused a little bit of havoc with some
Mhm.
of my stocks. Wheat became a buy again. Didn't really save GNC though in my portfolio. And Josephine for lithium this week. I know that we've got one lithium stock, I think, that we've been talking about. Everything else, iron ore is still a buy, gold is still a buy. Looks like coking coal is Josephine. I'm not sure where that. Oh no, it's a buy
No,
still. It's
no,
just popped
I
its
got
head
that
up.
wrong. When I was talking with you, when I sent you an email, it was I made the mistake of looking at the weekly graph, not the monthly graph.
Yeah, it's
Yeah.
it's just a buy. It's broken through its 2BL. But crude oil is a sell, copper and platinum are Josephines, aluminium's a sell, zinc, tin, Josephines, magnesium's a sell, manganese is a Josephine, steel is a buy, but LNG's a Josephine, nickel's a sell, iron and steel scraps a buy, and then titanium dioxide, our newest entrant, is still a buy, but very, very choppy on the commodity markets at the moment.
And just following up from the last show we did, I sold my South 32. I think you did from our portfolios. You asked the question because some of I think aluminium was half of South 32. It was a sell. And when I dug into it, I thought, yeah, the majority of the things that have were either Josephines or cells. So I think we should sell it.
Also, following on from last week, Mark Dugmore, our one of our mining guys, rallied to the call, talking about mineral sands.
Mm-hmm.
He said the prices for the heavy mineral sands products, rutile, hold on, go away, Siri,
Ilmenite.
leave me alone. Yeah, sorry, Siri just started talking to me. Rutile, ilmenite, the minerals as sourced for titanium metal. Think paint on the outside of your house, in the plane you next fly on, or in TK's golf clubs. Zircon, think tiles, are difficult to find on a regular monthly basis. Iluka Resources, ILU on the ASX, will sometimes have the benchmark prices in their ASX releases, but you can never get an up-to-date price graph. I tried to graph it some time back, but gave up because of the time lag. And he's given us a couple of charts to have a look at. But thanks for that, Mark. It's always good to have people that are in the know help us out with that stuff. But it looks like it's just going to be difficult to get real-time charts for mineral sands.
But you did find one for titanium dioxide, yeah?
Yes, that's the only one that I really have that's of any use.
Okay. Which is good. That's a mineral sand.
It's something.
Yep.
So, what have you got on your list of things to talk about today, TK?
Yeah, just a couple of things. I just noticed I was I did a download to decide what to do pulled pork on, and the stock I was going to do is called BRB, and I've forgotten what that stands for. I'll just have a quick look. Anyway, it was under takeover today, and the company that was taking it over is RMS, Ramelius Resources. So we've got one stock on the buy list taking over another stock on the buy list today, and I decided not to do BRB because it's up some 30% odd.
Whoa.
Yesterday. Yeah, big jump yesterday. That's Breaker Resources NL is BRB. Had a big jump yesterday when Ramelius decided to lob an offer. So
good luck to anybody who owns that. I don't.
I decided not to do a pulled pork just to preserve that that jump in the price of BRB. But yeah, it's been on the buy list, so good luck to anyone who owns it.
Mm.
So news from the buy list. I did want to talk about banking. I do agree with you 100% that it's noise, but it is there's a lot going on, and it is interesting to just lift a little bit. But I wanted to talk about two things. One was the fact that in the takeover of Credit Suisse by UBS, the Swiss regulators have written down the bank hybrids to zero. And that was the thing which caught my eye out of all this whole, ructions in the banking world this week. And why does that interest me? Because, I mean, do you know what a bank hybrid is, Cam?
No, I'm hoping you're going to explain all of that to me.
Okay.
Is it a bank that runs on electricity as well as petrol? No.
Well, sometimes. Well, I think Credit Suisse was running on hot air, but anyway, it's just it's another form of bond. Well, it's not a bond; it's a type of bond. That's why it's called a hybrid. It's got some characteristics of being a bond, and some characteristics of being equity. In other words, a share. And so banks will often issue these, which has characteristics of being a bond. They pay a yield, and then return the capital at the end, or they have the right, or sometimes you have the right to convert the outstanding amount into shares, into equity. So that's why it's called a hybrid. So they've been around for a long time. A lot of retail investors in Australia in particular will invest in bank hybrids. I never have. I don't know much about them. To me, it's as much about the credit risk as well as the price of the bond. So, I think it's a fairly specialized area, but like a lot of things in markets, people have gotten used to them. Retail investors buy them, and they tend to price them against other bank offerings. So, and they always have strange names, like CommBank issues pearls. Other banks issue, other hybrids with different names, and they have slightly different characteristics and slightly different prices. But people will generally say, "Oh, well, the new issue of CBA hybrids pays better than the latest issue of another bank's shares," for example. I tend to think they may have gotten away from the fundamentals of investing in this area, which is to work out whether you're being paid for the risk of being owed the money by the bank. Anyway, it's a big part of our market. Most investors, most people, of the general public haven't heard of it, but it's there. And it's been treated as if you're investing in a government bond, or at least in a big corporate bond. So your money return is assured. But as the people in Switzerland just found out, who invested in the Credit Suisse hybrids, the regulator wrote those $17 billion worth of hybrids down to zero. When it got UBS and Credit Suisse in the room and knocked their heads together and said, "Right, UBS, buy Credit Suisse." Credit Suisse went, "No, we're not going to honour these hybrids." Regulator said, "Oh yeah, read the fine print. We have the ability to write them down to zero," and they did. So, what I guess where I'm coming from is in the GFS, in the GFC, sorry. No one before the GFC, no one knew what a collateralized debt obligation was, a CDO and a synthetic CDO, et cetera, but they sure did during the GFC. And this is kind of one of the hallmarks of these things. We suddenly find out that there are all these products circulating under the hood of the banking system, which we never hear about, and suddenly one's just collapsed. And I read in the Fin Review today that the hybrids in Australia had been marked down 3 to 5% because of that. So I'm not saying we're in anything like the GFC, but again, this is an example of the products that are there in the banking system, which can become fragile under stress. That leads me to point number 2, which is that banking is just really all about trust. And I sat down with Jenny the other night and had a quick chat about this because of her experience in banking. And I posed the question today to her, and I said, if everyone in the world at once wanted to withdraw their deposits, how much do they get? And she said, well, they get the government guarantee. and that's it. Because the way banking works is it takes deposits and it rolls them up, and then it lends them out in home loans or in other ways, business loans, credit card portfolios, whatever, or it uses them as security to go and do other things and issue bonds and things like that. So, according to Jenny, if the way that the regulators stress test the banks, and I have to sort of parenthesize this commentary by saying the Australian banks are probably the best regulated in the world. Australian banks and Canadian banks were the only banks that came through the GFC pretty much untouched, and they're very well regulated. However, and the regulator in Australia, APRA, the Australian Prudential Regulatory Authority, is very, very good at keeping the banks up to scratch in terms of their risk profiles, because they know that the banks are important to the economy, and if the banks aren't robust, then the whole economy is going to have problems. So it's very well regulated in Australia. However, the APRA requires the banks to go through stress testing every now and then on a periodical basis. And one of the things it models is a bank run. They also model other things like, dramatic rise in interest rates, dramatic fall in interest rates, what happens in a recession, all that kind of stuff. And they try and make sure that the banks have enough capital to see them through any sort of stress on the economy like this. But when I asked Jenny about the bank run stress test, she said, yeah, they model the liquidity of a bank on a 30-day basis. So if everyone wants to get their money out of the bank in the next month, are they able to do that? That works on 30 days, but the SVB run happened in 2 hours, and some of the runs on Credit Suisse have happened because of the digital way that banking works now very quickly as well. So stress testing for 30 days isn't going to cut it in this digital world. And I'm not trying to make people worry about the banks, but it is built on trust, right? If we all wanted to get our money out tomorrow, we get the government guarantee. If we all want to get our money out within 30 days, we might get another 10 to 15 cents in the dollar, which is everything the bank can liquidate within 30 days, which is generally government bonds. There are some other substitutes there. And then it goes into other levels of risky assets and illiquid assets like hybrids and eventually mortgages. So, in the worst case scenario, if the bank had to pay out all its deposits, it may have to come and take away our house, sell it, get the mortgage back, or if we can't pay it back, and then pay out the depositors. That's never happened, but that's how it has to work if depositors want to get their money out. So banking is built on trust. So,
and after the Hayne Royal Commission,
well, Hayne was a sort of different thing. It's not about that. It's about but can you trust the bank? Yeah, sure, I get that. But it wasn't about the stress testing of banks, and that's
different kind of trust.
So
yes,
different kind of trust. But that's always got to be there, and I think in the back of people's minds in these situations is that if everyone wants to get their money out, A, they can't, and B, that's into the banking system.
And what is the amount that the Australian government will guarantee?
$250,000. And people should look it up themselves, because I'm not sure whether that's per account or per household or what. So, yeah, I mean, Jenny and I are thinking now about
crypto,
splitting our deposits up over different banks so we can make sure we get it back if there's a problem.
Not crypto. Crypto is the cure.
Not crypto.
No,
meant to be.
I saw somebody
or gold.
Saw somebody posting the other day the crypto price and how it's fallen along with everything else recently, and saying, oh, hold on a second, I thought this thing was supposed to be contrary to what's going on.
Yeah.